So this video will be a quick checklist of the main things that you need to know and understand before actually starting to invest. It's important to consider these things, otherwise we run the risk of not really knowing what we're doing, blindly jumping into it, and potentially losing some money as well. And the last thing we want to do is lose our precious money. Hey guys, welcome back. My name is Fezi, and today we're looking at the 4 main things that you need to know before actually starting to invest. If you're new here, welcome, and if you have already started to invest, this video will still be quite helpful to you. So as usual, this is not financial advice. We are talking in a general sense only, and I'm not a financial advisor. There's timestamps for all the 4 things in the description, so feel free to flick through them at your will. So the first one is deciding which broker to use. Now this might seem simple at first. After all, the chances are that you bank with a Big 4 bank anyways, and they seem to advertise their share trading platform quite frequently if you bank with them. So your first thought might be just to open up an account with them and to get started, but here is what you need to know. Basically, large banks understand how convenient it is for you to open up an account with them and to see all of your shares and internet banking all in one place, but you really pay for this convenience. So if you compare between the Big 4 banks, you'll find the prices are very similar. The difference is usually between $5 to $10 per trade. Now, depending on who you are, that might be a lot or it might not be. But just understand that you can get cheaper options. And despite how much they tell you that you're getting a competitive offer, it's only competitive if you compare it to the Big 4 banks. But if you look at other brokers, it's far too expensive. Now, the broker that I use is Self-Wealth. They charge a flat $9.50 for trades, and they don't have tiered pricing, so if you do huge trades, you'll pay the same. Best part of all is that Self-Wealth offers CHESS-sponsored shares, which means that you have direct ownership of those shares. Meaning that if Self-Wealth goes bust one day, the ASX themselves have a record of you owning those shares, so it's much easier for you to retrieve those shares. If you're still confused about this whole chess thing, don't worry, there's a link in the description to an article which clearly explains how it all works. And personally, I picked Self-Wealth because of this reason, and if you want to sign up, you can use the link in the description to get 5 free trades. These trades do expire in 30 days, so just keep that in mind, and I'll get 5 free trades as well. Now, speaking of brokerage costs, if you only care about that, there's even more cheaper options to consider than Self-Wealth. The Self-Wealth is not the cheapest broker if you're trading small trades. For example, IG.com charges a minimum $8 per trade for the first 2 trades, then a tiny $5 per trade afterwards. Or Superhero charges a flat $5 fee per trade or free trades on ETFs as well. Now these are super cheap compared to the other options, but they don't use the CHESS sponsored system, which means there's a bit of risk there. So essentially they are holding the shares on your behalf, and if these companies go bust, it's much harder to retrieve the shares than the other system. Now since you're new, instead of going with a traditional broker, you might want to use an easier platform altogether. So I made a video recently, there's a link in the description, and there should be a pop-up on your screen as well. So basically the whole point is, when choosing a broker, decide if you want the cheapest brokerage or if you want CHESS sponsorship or the convenience of a big bank. It's really up to you. The second thing to consider is the investment time frame. This is called the investment time horizon. It basically just means how long you expect to hold an asset until you need to sell it and get your money back. Now you might think that a time frame doesn't really matter because anything can happen in the future and there's no point really planning things in advance, or you might just want to invest straight away because you think it's irrelevant. But hear me out. If you're someone who's 18, just starting out in life basically, compared to someone who's 60 years old, who has loads of life experience, generally speaking, they will have different views on how they look at risk and essentially how long they want to invest for. An 18-year-old has many decades to invest versus a 60-year-old doesn't really have as much, plus they will need the money for retirement sooner or later. Therefore, the investment timeframes are going to differ, and so will their strategies. Typically speaking, a young person will be happy to take on the risk because they have a longer time frame to invest. Therefore, investing in a single stock or an ETF that tracks an index will seem like a good option because they have many decades. Because if you really look at it, as young people, if we lose all of our life savings tomorrow, it's gonna feel like crap, but it's not the end of the world, and we pretty much have our whole lives to rebuild. Compare that to someone who has kids, mortgages, other debt, and it's a huge deal. So someone who's older, it's not ideal to look at risky investments like stocks, because when it's time to retire and you have 100% of your money in stocks and a market crash happens, you may have just lost 30 to 40% of your life's work. So for shorter time frames, ideally speaking, some portion of the portfolio should be kept in cash or cash equivalents, maybe even bonds as well. You can still keep stocks, but not at a huge level, But at the end of the day, it's all really up to you. So as an example, if your time horizon is 1 year from now, and let's say you have a goal to buy an iPhone at the end of the year, and you've got some savings already, but you're thinking of either just putting the money in a high interest savings account or just putting it in a stock. So if you put all the money in a stock, there's a very high chance of losing what you started off with because there's risk. But if you do come out on top, you will generally make more money than the savings account. But if you put it in savings, although you won't earn much, you'll earn very, very little money. Your money is still preserved and there's low risk. So think about where you are in life, what your financial goals actually are, and that will basically dictate what time you're going to invest for. So number 3 is choosing what you want to buy. Now, I already went into this a little bit with number 2, but generally speaking, if you're investing for a short period of time and you don't like risk, you can avoid stocks or place a smaller percentage of your portfolio in stocks. Because as always, stocks do bring more risk. But rather you can look at things like a high interest savings account or fixed interest assets like government bonds or even corporate bonds. These give a return of about 3 to 4%, which is a bit more than the savings account. Now the return isn't as high as stocks, but there's less risk. Also, when choosing what to buy, think about your strategy. Do you need the extra income throughout the year through dividends or not? Now companies in the ASX pay out one of the highest dividends, and if your strategy is income, then you can look at companies that pay high dividends or even REITs. Now a REIT is basically a real estate investment trust. It's a company that owns real estate, and with this real estate they rent it out, and the rent that they receive is usually paid out to you via dividends. And REITs generally have high yields as well. You could even look at buying penny stocks or blue chip stocks. Blue chip stocks are basically companies that are large and stable. But once again, whatever you do, make sure you do the research because that's the most important part. Or if your strategy is purely long term, look into ETFs that track the broader market. Now, although the dividends won't be as high, you'll get the market return, and this is a passive way to invest. If you're still considering what to do, I made a video about 3 unique ways to make money on the ASX. There should be a pop-up on your screen as well. Now, number 4 is the last and final thing, and this is mindset. Now guys, look, this stuff matters more than you think, because if you're investing for the long term, you'll experience multiple crashes and quite a lot of corrections. And whenever this happens, you've just got to keep calm. It's really tough seeing your portfolio tank by 30 to 40%. I'm speaking from experience, and it's super tough. But just understand this, it is one of the best buying opportunities. Just look at the March sell-off. If you bought any time during then, you would have made some decent returns up until now. Basically, think logically, do not read the news every single day. These guys just make money off your fear, and it's just how it works. Look at your why, as in why you started in the first place, and focus on the goal. Now there's so much I can say on mindset, but the last thing I want to say is be careful of FOMO. If there's hype surrounding a stock, don't blindly invest. Always do your due diligence. Because the thing is, if you're only just hearing about a stock right now, it might already be too late. And millions of people just like you are already onto it, and it might not be worth it. So that's really all I wanted to discuss. I really wish I thought about these things before I started out. Hopefully now you have some sort of a checklist and know what to do. Please research and get these things in order before you start, rather than blindly investing and making costly mistakes. Thanks for watching, guys. I really appreciate it. Please like and subscribe for regular videos. I'll see you in the next one. But generally speaking,